In today's dynamic global regulatory environment, financial accounts, tax, and anti-money laundering compliance are increasingly interwoven. This narrative case study explores the journey of Mr. Alpha, a shareholder in a United Arab Emirates LLC company, and highlights the critical compliance crossroads that professionals must navigate. The UAE has established itself as a global hub for business opportunities. Notably, individuals in the UAE are not subject to corporate tax on income from real estate, investments, or salary. However, business or professional income sourced from within or from the UAE becomes taxable if annual revenue exceeds 1 million AED. Small business relief may be available if revenue remains below 3 million AED up to 2026, but registration with the tax authority is still mandatory for those crossing the 1 million AED threshold. Against this backdrop, Mr. Alpha, a citizen of Country P, operates an LLC company in the Emirates of the UAE. Business is thriving, and he just secured an additional project worth 20 million AED. While this is a great profit-making opportunity, it requires a working capital infusion of 10 million AED. What appears to be a straightforward capital induction transaction soon unveils deeper accounts, tax, and compliance layers. Mr. Alpha introduced 10 million AED from his personal account into the business over a 3-month period. He is currently a shareholder and the manager of the company. His known sources of income include a salary from his own company of 50,000 AED per month, which is to cover personal and family expenses. Mr. Alpha is also entitled to dividends, although no dividends have been declared to date due to the company's growth strategy. The source of Mr. Alpha's 10 million AED capital contribution must therefore be evaluated from the perspectives of financial accounts, tax, and AML compliance. Possible classifications of the funds include A. Capital repatriated from Country P must be proven to be post-tax income, must be legally remitted through proper foreign exchange channels. B. Loan or short-term borrowing from friends or family. Supporting documentation such as loan agreements and transfer proofs must be maintained. The source of funds of friends or family must be assessed as per AML requirements. C. UAE-sourced income. Salary income received is, although exempt from tax, since the benchmarking and compliance along with the work contracts are assessed. This is not the source of funds, since these expenses are primarily used to cover personal and family expenses, but not from real estate, as he owns no real estate assets. Not from financial investment income, as no UAE financial investments are in his name. Without a clear and documented classification, tax authorities may deem the 10 million AED as business income, especially if there is a pattern suggesting professional activity. If deemed business income generated in 2024, and if revenue crosses the 1 million AED threshold, Mr. Alpha must register for corporate tax under his personal capacity and may not qualify for small business relief since the deemed revenue is greater than 3 million AED. Parallel to financial accounts and tax evaluation, AML compliance procedures must be initiated by the auditor or accountant providing professional services who are classified as designated non-financial businesses and professions in the UAE. According to UAE regulations, professionals performing audit or accounting functions must conduct customer due diligence and assess the legitimacy of funds inducted into a business. Ms. Noor, an AML officer at the audit firm, flags the transaction due to several red flags. High-value fund induction, absence of substantial UAE-sourced income in Mr. Alpha's individual capacity, and no other declared business interests in the UAE. These indicators trigger enhanced due diligence, requiring Mr. Alpha to submit clear documentation proving the lawful origin of funds. Should any discrepancies or inconsistencies arise, Ms. Noor is obligated to file a suspicious transaction report with the relevant authorities. This case study underscores the convergence of financial accounts, tax, and AML compliance, particularly in high-value transactions. Professionals engaged in accounting, auditing, tax advisory, or compliance must understand cross-border tax thresholds and triggers, especially the AED 1 million revenue rule. They must evaluate the true nature and classification of income to assess tax obligations and potential eligibility for small business relief. Performing thorough AML checks focusing on the source of funds and their origin is crucial. Collaboration across disciplines, as coordination between tax advisors and AML professionals, is often essential. The Golden Project demonstrates how a seemingly straightforward capital contribution can trigger a web of compliance considerations. Behind every transaction lies a deeper narrative, and it is the responsibility of professionals to read it accurately and act with integrity. The convergence of financial accounts, tax and AML domains demands a proactive, multidisciplinary approach to compliance in today's regulatory landscape.